Happy Tuesday, everyone. I'm Dr. Laurie Davis, your host of the Today Show, streaming live right now on the Laurie Davis Facebook page, our YouTube channels, the Disability Channel, Twitter, LinkedIn, your home TV, you name it, we're there. And the show is growing. And Dr. Ramin, your show with me is like the fastest growing. So good morning to you.
Good morning, Dr. Laurie. Good morning, everyone. It's wonderful to be here, as always.
We look forward to Tuesdays because Tuesdays we have you at 9 o'clock and then we have Doug at 11. Yes. And today we're going to be interviewing Jeff, oh my goodness, Brubaker, hockey player and gone into business. So we're excited to meet him.
Awesome.
So you have something pretty exciting for us today. You know, you tend to be the fun guy and you do fun stuff and you always put some humor in there and we really enjoy your stories. But today we're going to talk about, and I'll turn the mic over to you because this is really important right now with the way the world is and where we're headed and what's going on. So over to you to share with our audience. What do you like to talk to us about today?
Absolutely. Yes. Of course, we want to have fun and it's important. But of course, we want to make it educational while we are having fun, or educational and having fun. But today, what is happening is with the world, we have had lots of volatility in the markets and actually in our lives, basically. So I thought it's important in this time of turbulence to find out what are the best ways to protect our situation, our investments, and what ways can we do about that? And is it about, should we just avoid risk completely, or we have to accept the risk? And I'll start with this, that life from the beginning is full of risk. I mean, from the day we are born, actually the day from we are conceived, we have no clue what's going to happen next. So you can protect yourself and try not to take any risk in your lives and end up being like Howard Hughes, who was one of the richest men in the world. And in 1976, he was afraid of dying and he died in solitude in a way. He was flying, he died of kidney disease, but he wanted to avoid being sick. And you cannot avoid risks. So what we have to do, we have to manage the risks and learn the ways to protect our investments without really sitting tight and not doing anything. So I even go further. In life, as I mentioned, life is full of risks. And General Patton, one of the obviously most famous generals in the United States, he went through World War II, all the wars, and 12 days later, after the World War II ends, well, he dies in a car accident. So things like this happen. So we can be prepared for something, but we have to understand that risks are all around. So when it comes to investments, it's the same thing. I mean, you cannot think that, don't want to be in this investments, on this investments, and I'm going to put my money in cash and I'm going to put it under the mattress. Nothing happens. So if you think there's no risk, even putting your money under the mattress, what you could do, just look to people in Argentina, look at people in Venezuela, in Iran, see what happened to their currencies. In a matter of not just years, in days, things go up and down and you lose the value of currency. Even I bring it to our world, post-COVID, when you look back, just in the United States, in past 3 years, it takes you $925 per month more to actually buy the same goods and services. So
Wow.
you could have said, "Oh, my money is in the savings account. I'll put it in the mattress and come back." Your money has lost its value. So, rule number one is we have to accept the risks, and we have to know life, and especially with our younger generation, it is risky. We cannot avoid it, but we can manage it. So that's what we'll talk about managing these risks. So it's going to be a little serious, but make it more technical today. So I hope
Right.
our audience will bear with me, and uh, I will share some of the things as a portfolio manager, what we look at, how do we protect our portfolios. So we look around us right now, we look to see from geopolitics to economies, what is happening? I mean, you look around, we have crises after crisis around the globe. You look at obviously Ukraine and what is happening with the Russian situation. You look at China, the second largest economy in the world. We look at Middle East, we see what is happening there with Iran, Israel. We look at Lebanon and Palestine. And so there are lots of risks around us. And it reminds me of it almost we are in the same environment we were in late 1970s and early 1980s. And the only difference is that when I mentioned the three names with like Russia, China, and Iran, these forces actually working cohesively together. So that's even bigger risk. So we are back. We used to have the Cold War. We are back to that, the superpower struggle. On top of that, add the elections around the world. We've had,
Oh,
in
wow.
Russia with Putin, and we've had from India, even with Olympics in it was a wonderful Olympics in Paris. It was great. Now President Macron has to come back to reality of life, that he has no government really, his parliament, there is no coalition event. So risks are there. And of course, the biggest of all, we have elections in the United States, and we are on the razor edge. So basically, as I go back geopolitically, we have all these uh, again events going around us. On top of that, economically, what we've had the inflation fears, and the markets have been looking at that. And then United States, we come out with a few weeks ago, we came with the employment numbers. Things are slowing down now. The fear is, are we going to have recession? So we go up and down. So you add summer months, you add August, which is it's the time that in Europe everything is shut down. A lot of investors and traders are on holiday. They basically not around. In the United States, similar things. So you see a lot of volatilities in the market, especially in stock market. And then you look at what happened in Japan. We call it a carry trade. So a lot of things happen, and that adds to the risk. So when you don't have a lot of players, the professionals around, the volatility is exaggerated. So usually in the United States, after Labor Day weekend in September, when people come back, then they start digesting the news. So basically what they have to do. But so right now we are on the edge. For instance, this morning we had our producers inflation number in the United States. Tomorrow we have the consumers inflation. So the markets are watching those things. So having said all of these, so what do we do? Now, what are we going to do? Our portfolios are going up and down every day. We watching it. We see, oh, last week was one of the worst days, or actually, yeah, Monday was one of the biggest days and the biggest drops we've had in over 2 years. So do we get nervous, and do we have to do something about it? So this is what I'm going to share today. And the investments doesn't have to be stock market. It could be in real estate. It could be precious metals, currencies. But most people right now, they are very much involved, at least in North America, with stock markets because of their retirement funds are mostly in stock markets. So They are more concerned about the volatility of the market. So I will emphasize on that, but it generally covers everything. So again, the topic will be, how do we reduce our risks? We manage our risk, not to avoid the risk. So that's an important factor. And as I mentioned before, it's risks are around us, and without taking risks, there won't be any success. So that's what we get rewarded, because we are taking those risks. So again, we call this hedging in the language of portfolio management. How do we hedge our risks? And basically, the purpose of hedging is not to completely get rid of the risk, it's just to reduce the risk to the place that we can actually sleep at nights comfortably. And that's the goal of hedging. Now, one of the things I have to emphasize, like anything else in life, when you invest, and this is a big culprit of our investors, anyone who gets into, whether it's cryptocurrencies, Bitcoin, or stock market, even real estate, people just walk in. A lot of times, the investors are just go in randomly. What is the tip of the day? What is the hot thing going on as of this moment? So there is no plan. There is no mission statement. There is no idea. When we want to buy a car, people investigate everything, they Google. When it comes to investments, if the neighbor said, "Oh, go buy this stock," oh, I don't want to miss the opportunity. So they just randomly involved. They get involved with, as I said, Bitcoin or cryptocurrencies, or it could be stocks or any other things. I know a lot of audience probably have gone in last 24 years. We've had three major crises. When you talk about investment crisis, we had the obviously technology and internet bubble in early 2000. Then in 2008, we had the financial crisis, which was huge, which was really real estate and financial related. And of course, we all remember 2020, which was not really financial crisis, it was a healthcare crisis, which became global financial crisis, COVID, which actually became a social crisis. So we remember those, and we've gone through those. So what we have to do is, this is a good time to sit down and have a plan. And most of us, we try to avoid that because of maybe it's time consuming, or we don't have the education. So, but it is very, very important. And that's will be my rule number one for everyone who wants to get involved with investing, is you have to have, in portfolio management, we have something called investment policy statement. And if I have clients, or if I have, institutions coming to, we want to make sure we are clear what we are doing. Basically, what kind of investments we get involved, when do we take our profits, what environments we will stay in, what stocks or investments we will avoid. Everything has to be clear. When do we exit? How much loss are we willing to take? So it's not just random watching our portfolio. And then we want to have a length of time. We have to be very clear. And a lot of good investors who are like invested in their retirement accounts, they say, you know what, this is a long-term investment. I have time on my side. So any these clips, what happens, I'm going to stick with it, because over 10 years, stock markets have been positive in a rolling 10 years. So if I can weather that, I'm not going to worry about it. So as long as they have that attitude, they're okay. So they don't have to worry about day-to-day things. The problem is the human psychology, and our access to all these information on a microsecond obviously affects us psychologically. I mean, we can't avoid it. In the past, you will get a newsletter, maybe of paper, once a day or once a week. You would read your Barron's. Now it's like instantaneous. So you already aware of what's going on, and that makes you nervous. So that's why it's important to have that clarity, to know what is my plan, what is my outlook, when do I get out of my investments. Um, Do I have a comfort zone or risk zone that beyond that, I'm going to lose sleep? Beyond that, I'm not comfortable. We have to set those up. And if we can do that, then uh, life will be a lot easier. We have our own other complications in life. They have a lot of things that we want to do. So this is should be just a portion of it, not taking all our energy and worrying about what's happening, with our investments. So uh, the one thing about hedging is also hedging could be just one portion of your investments. Let's say it's just the stocks or specific stocks, or hedging could be your total investments. And we'll talk about that. So with that, if you have any, um, want to take a break, we can come back and I'll.
Yeah, for sure. No, that's really interesting. And, like you said, riding those waves, if we can learn how to ride the waves, then everything will be fine, but it's when people get caught in those situations and they don't know how to get out, or they don't see a way out. I mean, look what happened during the Dirty 30s. People were jumping off bridges, right?
Absolutely. Right.
Yeah. All right. Well, we'll be right back after this little 30-second break where you can be featuring your products, your programs, your services. If you have an event coming up, this would be the place. We're on the air every single day. Here we go.
The day is set. Join us October 12th, 2024 at Carrigan Arms for our next fundraiser in honor of veterans, the Invictus Games in British Columbia, Canada, and TDC Employment Program Enrollment. For more information, email us at info@thedisabilitychannel.ca. Introducing Veteran House Alliance International Monthly 50/50 Raffle. Purchase your ticket today, link on display, and have a chance to win cash and help a great platform supporting veterans.
Welcome back, everyone. You're watching the Today Show. I'm your host, Dr. Laurie Davis. And of course, on Tuesdays, we always have the pleasure of our partner here and telling us and talking to us and speaking to us from an area of finance, his area of expertise after all these years. Wow. You're like a walking encyclopedia. Do you know that? Wikipedia has nothing on you when it comes to finance. So today we're talking about protecting our investments during, uncertain times. And I did hear something this morning about Iran. I forget what it was, but, it's things are happening. And I mentioned that because it's your homeland, dear to your heart, but it's all over the world, isn't it? I mean, things, and you mentioned this too, the number of elections going on around the world right now is like historical. I don't think there's ever been this many at the same time. So those are a few things that I picked up from your conversation this morning so far, and how to, I like that word, hedge, to take care of things. So back over to you, Ramin, for more info on how to protect our investments.
Thank you so much. Yeah, well, you hit the nail on the head as far as election goes. Yes, this is in the history. We have more than 52 to 54% of the world population this year has gone or will go to the polling ballots and start voting. So basically, it has been the most drastic election year in our history. So from India to Russia. I mean, we've got all over the world, Brazil, and of course we had Venezuela, which now President Maduro has threatened the whole world that you have no right to obviously interfere in our free election. So basically it's happening. And of course, as I mentioned, United States, we've had, I mean, I think in our history, we never had anything close to what has happened in the last few months, when the sitting president decides not to seek the election and the vice presidents, continues. And, we did go to in the 1960s Lyndon Johnson, but not to this extent. So anyway, going back to our hedging. So as I mentioned, the rule number one, I'll really encourage, whether you're a seasoned or new investor, please sit down, have an inventory, and have a clear plan. The problem with, like you just mentioned, is when there's volatility is we are not prepared, so we become very emotional. When
Mhm.
things are written, when we have that clarity, when we do write things down before it happens, we have a sound mind. We are not emotional. So at that moment, we even when I do the trades, before I get into the trade itself, I write down, because I don't really have any attachment to my trade. Because I don't have attachment, then I'm biased. So I am looking at it from the outside, and it's a lot easier to manage. The minute that we involve in things, it's same thing with relationship. It's funny how we can make these judgments about our friends in the relationships. Oh, you don't know this, and you don't, because we're watching from outside. It's funny how things change. We ourselves get involved with the relationships or our work, or so it's all of a sudden that clarity goes out the window. Emotions come in, the attachments. The same thing in investments. If you are attached, then the emotions really take over. So it's better to write down your, whether it's, I call it the IPS, investment policy statement, or whether you have a one-page mission. I would do this, but I won't do that, or I would get out of my position if I lost 10%. Once they are clear, because we have no attachment, you have no attachments, then it's a lot easier to apply that. But once we are in, we start negotiating. I've said it before, we start become religious, we start praying, things that we weren't doing before. All of a sudden we are God's best friend if we break
Right.
even. So basically, this is the things you don't want to do. So number one thing before we even get to that, and that's what is one of the best ways to hedge your portfolio, is diversification. It's amazing, we talked about, in the past, at least that, I've gone through about 40 years of crisis, but the last 24 years we've gone through different things and different markets. So like in 2008, like in bonds market did well, gold did well, while everything else was dropping. Stock market, S&P dropped 30.5% in just in 2008. From top to bottom, it dropped 46%. Imagine, half of your money was gone. A lot of people who had their money in 401ks and retirement funds, they had to go back to work because they were planning of retiring, and things like this happen. So it's better to be, again, prepared. And that's what diversification is important, putting your assets in different, or your portfolio in different asset classes, whether it's some in real estate, some in precious metals, some of them in the different stocks, in international investing. So there are all types of investments. So make sure you are not just in one wave, as you mentioned. It is not just right now. Obviously, like artificial intelligence stocks are really hot. That segment, everybody's, yes. When things are good, everybody rides that wave. When things go against you, things really drop fast. So that's why we don't want to, again, just focus on just one element. Now, if you're a professional in other things and you have the time to sit down and analyze individual stocks or individual investments, then yes, you can be concentrated. Like Warren Buffett, he is very much into the business. He knows in and out what is happening, very much involved. He got a great group of people working for him. So he can have like only 20 positions because he's in it. Or a lot of success will have it concentrated because that's their business. But generally for average investors, they don't have the time or the background to do that. So number one will be the diversification. Number two, as far as when you are into these crises and you cannot sleep at night, is the easiest way will be, oh, I will just sell it because the markets, and I can come back and buy that investments later. So depending on your again time horizon, you can sell, put it in cash, and come back and buy it. Now, one of the things it will be that when you are selling, it could be creating some other problems, because if you have taxes, for instance, capital gains, you have to consider. Now, if you have retirement accounts, that might be easier. But again, retirement accounts are long term, so sometimes you can just sit tight. So the easiest way will be, of course, selling, but that might not be the best way unless you've already had a plan. For instance, we call it like you've had stops, or we call it or trailing stops. And stops are like, once you got into position, you say, if I lost 8%, 10%, you can call your broker, or nowadays everything is digital, electronically. You say, listen, if I lost 8% on this position, get me out. Because I can live with 8% loss, but it's very difficult to live with 50% loss.
Mhm.
So, because it can continue, and that's why we have to avoid that. So, there's something called trailing stop, and trailing stop is you can put it in, and this allows you to take advantage of moving markets going up. So it moves with it, but as it moves, it puts that I just put 8%. It says, market, if you dropped 8%, get me out. So the trailing stop is dynamics, move with the market. The actual limit stop is actual number. You say, okay, I bought it at 100. If it hits 90, get me out of here. So right there, there's that 10%. I'm out of it. So that's just a stop limit, we call it. But trailing stop is dynamic. So if your 100 is not 200, and you put 10%. Now, if it is below 180, you can get out. So that's one way. The other way, which I don't recommend to, again, average retail investor, is shorting the market. And shorting means going opposite. All of us, we know about buying things. This is actually, technically, you're borrowing something and then hoping it will go down so you can buy it back. Shorting, it means you're going against the markets, but it can be risky. So you want to make sure you know exactly what you're doing. One of the best ways, and this is something, again, it comes with education, and that's what I really emphasize, that if you want to get involved in investments, have a fundamental understanding of the investing. Get to know things. I know sometimes it's just boring, and I relate that to like playing piano. I mean, if you were a child and your teacher was saying, have a disciplined system and practice every day, and your brain is getting accustomed to that. But if you learn the things in a correct way, it stays with you rest of your life. It's like riding your bike, right? Driving. You want to do the things the right way, and with education, it comes that reward in the future. The problem with investing, because it's all the information around us, everybody becomes an investor. Everybody becomes a trader. I mean, you go back to COVID times, everybody was like genius. The markets were going up after it went down all the way down. We got all this money not working. We are at home, got the laptop, we got internet, boom. What do? I'm a trader. Well, 2 days ago, I was working, let's say, in a restaurant, or I was working in a coffee shop. Now I've become a professional trader. So things don't happen that way. So one of the best ways to educate yourself is, again, understand the fundamentals. And one of the best vehicles is options. Options are derivatives. They are derived from something. And if you learn options, this is as a portfolio manager, we use options quite a bit to protect our portfolios, options and futures market. So that's one of the best ways. And options allow you to actually magnify your portfolio's value in a way that, because you are only using a percentage of the capital, it allows you to have more power. And basically, options allow you to protect your investments for a short term. So we have something called calls, and calls are something that when you feel the market's going to go up in options, you buy that. So you put a very small percentage of the total holding, and if the markets go your way, you make money. The other side is put. And put is you're betting the markets are going to go down. So when the markets go down, you make money. So one way of understanding this options terminology, a call is we call to God. So we're looking up. That means it's going to go up. So we are hoping it will go up. Put, when you put things down, that means we are hoping things go down. So we make money. So using the strategy, by buying put options on your portfolio, whether it's individual stocks or it could be a segment like S&P 500 or NASDAQ, you protect yourself in almost like buying an insurance. You pay a premium. If the markets go down, you will make money while your portfolio is losing money. Remember, you are not selling your portfolio. So this protection comes at a cost, which is an insurance, but it gives you that peace of mind knowing that even if the markets went down, you still made money, or at least you kept most of your money. So that's an insurance. It gets a little complicated. There are different types of these put options. You can put the spreads. So I use this as a technical, and again, if anyone is interested, we can talk a lot about that. When you have a short term, like now, August is very volatile. September is the worst month generally of the year. It's a negative month. So if we have that knowledge, we know for next 2 months, it might be a good time to take a break, go on vacation or do nothing. So for that, as a portfolio manager, we establish something called, it's an option strategy. We call it collar. COLLAR. And we also have something called fence, collar and fence. But collar is very important hedging tool that we use. If I have tens of millions of dollars exposed, what I use is I just freeze time. I put like a little, like a collar. It actually keeps me within a range. So whether the market flies up or the market goes down, I am going to stay within that range. So regardless of what happens, with establishing strategy, I can have my portfolio, but with this strategy also, I know I will not lose, for instance, more than 2% of my money, but also I won't gain more than 2% of my money. So this is technical, but it is something out there. It's a good idea if you have a large portfolios, especially, and you're worried, if I'm going to lose hundreds of thousands, it's a great option. Fencing is similar to collar, but the fence allows you to take more advantage when things move up, so you can move with it, but it protects you on the downside. So these are more of the option size. You can also have long-term options. It could be a year or 2 years. You can put it on your portfolio and basically protect yourself for the next year or two. But of course, you're paying much larger premium because it's the time. So, the insurance company is protecting you for next year or two. So you have to pay a lot. So sometimes it comes costly. So basically, those are the option related. We also, as a portfolio manager, we use something called futures market. So if I have a large holdings in stocks, I will short using futures. I will sell futures to protect myself. So as I said, today is a little technical, my apologies, but what I want to tell our audience is there are ways that you can actually protect without worrying about, oh God, I have to sell. And it's funny, every time I sell my positions, markets go up. Every time I buy the market, markets go down. So these are the psychological things we have. A lot of people say, everything was doing well till I got involved, as if like the markets were waiting for that investor to get in. But it is what it is. A lot of times happen because we're never paying attention before. So what I'm trying to tell our investors is that yes, there is ways that you could have control, because a lot of times we have that helplessness, lack of, the markets are of course in control, but I can't do anything. Markets go, I got to go with it. It's that herd mentality. But I'm going to tell you that No, you do have absolute control in those ways, and you can, with the right tools, you can protect your portfolio, especially if it's short term. It is the risk can be minimized, so and
Right.
you can do that.
Right.
So um
Oh, we're
should I
good.
continue?
We're good. What I'm
Oh,
hearing you say though is, a lot of we did a show on biases,
mhm.
and that applies here, doesn't
Yes,
it? Because
absolutely.
when you shared your list of biases that we have, based on rumor, advice from a cousin who's not really an investor, um, all that, the snake bite, I particularly like that one. So dealing with those biases is also a part of protecting our portfolio, I would say.
Oh, absolutely. And sometimes,
Managing.
again, it gets exaggerated. Oh, you mentioned something which came from those biases, the denial, right? Not
Oh, yeah.
accepting the markets go down 20. I'm still not, no, we'll come back.
No, they don't.
No, as I mentioned, if you have that clarity and we know that we are in this for a long haul, yes, we can. But also, we have to be truthful to ourselves. And, if there is, for instance, if I'm holding Kodak, these days, I mean, well, that's not coming back. I mean, people are not taking pictures and taking to Photoshop. So you have to accept the realities a lot of time.
Mhm.
Sears and Holding, Sears and Roebuck or Bed Bath and Beyond, well, they're done. There is no, coming back. So we have to accept the realities. There is no typewriters. There is no 1 hour photo
Yeah.
development. So we have to stay with time. So sometimes that denial is important. That's those biases, as you said. And unfortunately, when things are good, we are genius, as I mentioned, and this is our doing. And when things go bad, is everybody else's fault. And then we get emotionally really reactive. And the whole point of our, again, show today is I don't want to be reactive. I want to be proactive. You don't want to be nervous after things happen. You want to be prepared.
Mhm.
So one of the some of the times we cannot do options because we don't really have the knowledge or maybe don't have the tools. Or of course the futures market, we don't know. There's special formulas that we use. So but maybe we don't have access to these knowledge. One of the best things in past 20 years, especially past 10 years, has happened is the um, evolvement of the exchange traded funds. We call them ETFs. And it has allowed average investors to have access to every kind of investments out there, from commodities to exotic investments to currencies, and also hedging tools and some of even the options. So it allows an average investor, just by investing in exchange traded funds, to be able to be part of a large institutional investments. I like corn. Well, do I buy futures on it or do I go buy? No, there's a corn exchange traded fund. Okay. No, corn really doesn't have any much relationship with like stock market in a way. So, well, I want to have some corn. I want to have some gold. I want to invest in Japanese yen. Their exchange traded funds work like a stock. You can buy and sell it, but it makes it so much easier that you can play global markets, global commodities with one click. And that's one of the best things happen. The costs have gone down. There is no really a lot of brokerage firms do not charge commission. So that is one of the best ways to diversify your portfolio by purchasing it, regardless if you have small or large. You want to have a gold holdings, and these are actual real golds or gold miners. You can do that. But one of the best ones are called inverse ETFs. And what inverse ETFs do, and I will use it for more short term, you can, by buying that, you're protecting yourself, because what they are doing, they're betting that when the markets go down, you will make money. So here you buy your insurance without going to the options or without going to other, by purchasing ETFs, this exchange which are called inverse. and that could be double or triple too. They can be exaggerated, which becomes risky. You can actually have your portfolio protected for the short term. These are not very good for a long term, so you have to roll it. And generally, my rule of thumb is if you use put options, if you use these inverse ETFs, try to use it, I would say 45 to 70 days or even less. I mean, it could be 10 days, but not more than 70 days. So you have to constantly be involved with it. So basically, you're buying short term insurance. So don't go buy like an annual insurance. So this is one of the best ways. And for S&P, there is one. For real estate, there is one. There's for technology, NASDAQ, semiconductors, and there are many different ones that you could use to protect your portfolio. So you can ride the wave, as you said, at least for next 2 months and go on your vacation. Granted, you're paying something, but this allows you to, again, sleep at nights. You're willing to pay 2% of your portfolio or 1% as an insurance, knowing that you're not going to lose 10% of your portfolio, or you're giving up 1% of your gains. And also, one of our biases is regret. It also allows you that if the markets turned around and really jumped up, went up 10%, you say, oh my God, why I sold it. I wish I wouldn't have sold it. By having these insurances or hedging, you really did not lose the opportunity because the markets, when they went up, you were part of that. Another ETF that you can use is the volatility ETF, which is VIX. And VIX allows you generally, we call it fear gauge. When markets are nervous, go up and down, the volatility jumps because we don't know what's going to happen. And it's very much related to the options premium we talked about. And you can actually have a VIX ETF, have it in your portfolio, very short term. Again, these are very short term solutions, but at least it gets you over the hump till you get some closure. For instance, right now, with US markets, the idea is hopefully we go through this election, things get down. In the United States, the other thing is, the central bank, the Fed, is meeting September 18th. They decide how much they're going to reduce with the rates, interest rates. So we get some closure. So till we get to that, let's say till we get to September 18th, 19th, this volatility will be with us. So this actually kind of reduces that, again, the volatility, and that's through the hedging. So
the Disability Channel would like to thank our existing sponsors. We really appreciate the support and kindness from the BIAs across the GTA, Ontario, Canada, and our friends in the USA. We love making new friends. Thank you for supporting our existing employment programs.
anyway,
Excellent. Wow.
some of again.
And I think it's really important for, this goes back to a life skill. You know how people will say, well, in that situation, I didn't really have a choice.
Yes.
Have you heard people say that?
Yes.
When in fact, the word choice means we have options. There's choices. We have options.
Correct.
But the challenge is being that great decision maker, avoiding making the decisions, right?
Correct.
Right.
Excellent point.
So we procrastinate.
Excellent.
And you'll always have choices. And I think today you're helping us to understand that we do have options when it comes to protecting our investments. And maybe a lot of people aren't aware of that. They just think if they make that decision, then they're stuck with it and they have to live with it for the rest of their life. And that's not really true. Life isn't like that.
No, that's excellent. That's very good observation, Dr. Laurie, because that is that helplessness. And also helplessness can be contagious. So that's one of the reasons the bubbles happen and the markets go down so rapidly. So, I've said it before, the old saying, you take the steps or escalator up and you take elevator down. So elevator goes, so when the markets go down, they go down rapidly.
Right.
And that creates that obviously big fear. The news is, and then it happens in professionals. When we talk about portfolio managers, we talk about herd mentality. They don't really pay a price. Not many portfolio managers have been fired when the markets went down, while there have been some excellent portfolio managers when the markets were on a bull market. I can give you some stories about, I was very much involved in the tech bubble, and I'm a value investor. I look for good values, good companies, good businesses to invest in. But if you recall those internet bubble, all these companies were coming into the picture in the late 90s. I remember 18-year-olds getting out of high school and stuff, going to college. They were setting up their internet company, and they were saying, well, we're selling them our shares for millions of dollars because we have this one idea. We're going to come up and we're going to make it, this internet company for whatever it was. So basically everybody was on a bandwagon. And I remember some of the best fund managers, because they were not producing 30 or 25% a year, they got fired. And of course, a year, 2 years into 2002, when we had the recession and all the collapse happened, they were right. They were correct in looking for the really value companies. But when the things go down, because everybody else is going down, the portfolio managers, these professionals, do not pay a penalty or price, because they say, well, the markets went down, so it's not my fault. So you call your investment advisor and say, well, why are we down 40%? Well, it's not my fault. Everybody else is down. Now, one of the most proudest moments that I have, like in 2008, for instance, I remember our portfolio was actually, we were up like 1%. The reason was we were hedging. In 2007, I saw signs, and I'm not blowing my own horn, but it's just the reality that I could see things were overheated. In October 31st, 2007, we started hedging, shorting the markets. We still had positions, but we were gradually getting out of it. So by end of 2008, we were, in a good position. And of course, there've been times that markets have done 100%, and I've had clients who came to me in late 90s. Why did we make 24% or 25% in our portfolio while so and so is making 70 or 80%? And I have fired two clients because I said, well, we are not matching. We didn't have the length of time anyway. Most of my clients, average, they had been with me for 24, 25 years. I mean, at the end of my career, so things like that happen because we are emotional. When things go up, we are always thinking, oh, we are missing out. Oh my God, everybody else. When things go down, we have the excuse that everybody else is going down. So the idea is, like correctly you mentioned, it's the choice. We do have tools available to protect ourselves. And this is a very good time. August is, again, it's volatile. If you go to Europe, if you go to Rome is fenced. I mean, it's like nobody's really doing much. Everybody's on vacation, or Germany, or everybody's on vacation, so they really don't have time. And now that once the schools are open and the families come back, things start moving. But again, the volatility gets exaggerated in months like this. So
Right.
be prepared. And it goes back to everything else. Sports, you look at Olympics. Do you think that happened in 10 seconds? Talking about 100-meter,
Yeah.
that 10-second or 9.5 seconds of their lives, do you think it just happened? And that was the results of 4 years, 5 years of preparation, which was
Yes.
squeezed in 10 seconds. So the gymnasts, I mean, it's fantastic. I love sports. This is one of the main reasons. And then you've mentioned about Ron, your partner, your husband, being, aircraft engineer, being that detail oriented, being that precise, looking at things. It took many, many years of education and experience to know which screw to turn.
That's right.
So when it's screwing the turn, the screw itself is $1, but turning that is $10,000.
That's
So
right.
it takes 10 seconds or 5 seconds, knowing how. And that's what my message to our audience is. It's always, learning, but the right tools, basically. And
Right.
that's what I'm hoping, we relay that message, that there are ways to do that. So,
Right. Well, what's that old saying? It takes 25 years to be an overnight success,
yeah, well, that's
right?
the same thing. Yeah,
How about 32
athlete.
years? Right. And
Absolutely.
yeah, and someone made a comment to me last week about, being on the air so much and why do I want to be on the air and I'm really good at it and all this and I can interact with just about anyone. And I said, yes, but I've been on the air for like almost 30 years. How
Yeah.
many hours did it take to become proficient? And that's like you've done your homework as well. And that's why you know so much about what you know. But it didn't happen like yesterday. This has been decades that you've been working on. I don't know how many podcasts have you created or how many slideshows have you built. You want to give us a few statistics, just so people know who they're dealing with here?
No, we've had I think over 750 podcasts, and these podcasts are not like 1 minute; they're like
No.
45 minutes, an hour, and we've had courses, and uh, I think I have like about 30,000 slides now, and but it's fun. I mean, we are life is continuous learning, right?
Yes.
And that's what death is. Once we stop learning and living, that's not physically but
Yeah.
basically mentally, and not learning. So we constantly, that's, I'm always learning something new, and that's what gets us going. So 30,000 could be 60,000, who knows?
Yeah,
And that's
exactly.
healthy.
Exactly.
Yeah.
So, and I know that someone asked me also recently, because as you know, I had a birthday in July, and they said, "So, so what is this with you?" And I said the very same thing because I've always open to learning. That's one of the reasons I get up every morning. What am I going to learn today, and where is that lesson going to come from, or from whom is that lesson coming to me?
Right.
It could be a lady in the grocery store lineup. It could be a little kid that comes to visit. It could be spending time with friends. I'm always anxious to do that because I know I'm going to learn something new and learn something new about Laurie, learn something new about me that I didn't even know was there. And that's exciting. I find that really exciting.
Right.
I didn't know I could do that. Right?
It's the
Yeah.
best, actually. So
That's right.
yeah.
And I said to a client the other day, the study of self is one of the most exciting studies you'll ever have because it's like infinite. There's no end to it. Hmm.
Correct.
Yeah. All right. Well, we're getting ready to wrap up, and I just want to thank you so very much. Is there anything else that you'd like to share? We have a couple of minutes before we sign off.
Well, actually, I'm excited. I'm coming to North. I'm coming
Yes.
to Canada, and I will be first time I'll be visiting Saskatoon. So I'm excited
Yes.
about that, and really looking forward to it. So it should be a wonderful visit, and productive one, I'm sure. So
Yes, we have a jam-packed week. We're going to be traveling up north and spending some time with some really beautiful people. And there'll be terrific food. And I'm a personal friend now of the chef, so he'll be making exceptional meals, I'm sure. And yes, meeting some of our team members, and we've got a tight schedule for you when you come. But that's because we need to take advantage every time we visit back and forth to make the best use of our time and get that rocking and rolling. So because we're all about health and wealth equals happiness.
that's right.
Right? So
That's
when
right.
you're healthy and you're wealthy, gosh, happiness is right there. Right? Bullseye. You can't avoid it then.
No,
All right. Well, we're coming up in an hour with Jeff Brubaker and Doug Smith, NHL superstars, and we're going to do a show, The Press Box, in about an hour's time. So stay tuned or come back. And thank you for being here. And we'll see you next week. And then you're on your way to Canada. So
that's right.
bye for now, everybody.
Thank
and
you.
have a great rest of the day.
Yes. Bye for now. Bye bye.
And the Lord my God, he answered me, and this is what he said.
Write the vision and make it plain upon tables, that ye may run that readeth it. Habakkuk 2:2. Now you go and live your dream.
I'm living the dream and loving my dream. My God supreme, a winning team. I'm living the dream. I'm living the dream. I'm living the dream and loving my dream.
Everybody now.
I'm living the dream. I'm living the dream. Amazing dreams, a winning team.
No, 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 no. No matter what comes my way, I'm choosing to succeed. Yeah. Excuses stop today. I'm going to find a way. Yeah.
No matter what comes my way, I'm choosing to succeed. Yeah. Excuses stop today. I'm going to make a way. Yeah. I'm living the dream. I'm living the dream and loving my dream.
Everybody now.
I'm living the dream. I'm living the dream. Amazing dreams, a winning team.
No, 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 no.
No matter what comes my way, I'm choosing to succeed. Excuses stop today. I'm going to find a way. No matter what comes my way, I'm choosing to succeed. Excuses stop today. I'm going to make a way. No matter what comes my way, I'm choosing to succeed. Excuses stop and loving my dream. I'm going to find a way.
Go and live your dream.